Hey everyone, welcome back to Investor Talk. Today we're diving into a topic that has huge implications for your investments, the economy, and even your daily life. We're talking about the Federal Reserve interest rates and what happens when the Fed decides to make a cut. Understanding how interest rate cuts work can be the difference between making smart investment decisions and getting caught off guard. We're going to break down exactly how a rate cut ripples through the stock market, the bond market, the value of the US dollar, and even things like housing prices and inflation. All right, so let's imagine the Federal Reserve announces a rate cut. What's the first place everyone's looking at? You guessed it, the stock market. When the Fed cuts rates, it becomes cheaper for companies to borrow money. That means they can invest in growth, expand their operations, and potentially boost their profits. And when companies are making more money, guess what? Their stock prices tend to go up. But here's the thing. Not all rate cuts are created equal. If the economy is already doing well and the Fed cuts rates, it can feel like adding fuel to the fire. The stock market might celebrate with a rally, but there's also the risk of things getting overheated. On the flip side, if the Fed cuts rates because the economy is looking shaky, the stock market's reaction might be more muted. Investors might see it as a sign that the Fed is worried, and that can create uncertainty. Different sectors of the market react differently to rate cuts. The bottom line is, a rate cut can send shockwaves through the stock market, but it's not always a guaranteed win for investors. All right, so we've talked about the stock market, but what about the bond market? Bonds play a critical role in this whole interest rate game. When the Fed cuts rates, it directly impacts the yield or return that you get from bonds. Think of it this way. You buy a bond today with a certain interest rate. If the Fed cuts rates in the future, new bonds will be issued with lower rates. Suddenly your bond with the higher rate becomes more valuable because it's offering a better return. But here's where things get tricky. When interest rates are low for a long time, it can create distortions in the bond market. Investors might start taking on more risk to chase those yields. Bonds are supposed to be the safer, more stable part of your portfolio, but low rates can tempt investors to reach for yield, leading to unintended consequences. Okay, so we've covered the stock market and the bond market. Now, let's zoom out and look at how a Fed rate cut impacts the global economy, starting with the value of the US dollar. When the Fed cuts interest rates, it makes the US dollar less attractive to foreign investors. If you're an investor in Europe and you can get a higher return on your money by investing in US bonds, you're more likely to exchange your euros for dollars. That demand for dollars helps keep the dollar strong. But when the Fed cuts rates, that interest rate differential narrows, and suddenly the US doesn't look as appealing. The demand for dollars goes down, and the dollar weakens. A weaker dollar can be a boon for US companies that export goods because their products become cheaper for foreign buyers. But a weaker dollar also means that imports become more expensive for us here in the US, contributing to inflation. One of the main reasons the Fed cuts interest rates is to stimulate economic growth. When borrowing is cheaper, businesses are more likely to invest in expansion, hire more workers, and boost the economy. Let's say you're a small business owner thinking about opening a new location. If interest rates are high, taking out a loan might seem too risky or expensive. But if the Fed cuts rates and loans become more affordable, suddenly that expansion plan looks a lot more appealing. Lower interest rates can also encourage consumers to borrow money for big-ticket items like cars and houses, which can further stimulate the economy. But rate cuts aren't a magic bullet. If the underlying economy is facing serious structural problems, a rate cut alone might not be enough to turn things around. We've talked about how rate cuts can stimulate the economy, but there's a flip side: inflation. When the economy heats up too quickly, prices tend to rise as consumers and businesses compete for goods and services. If everyone suddenly has more money to spend because of lower interest rates, but the supply of goods and services remains the same, those prices are going to go up. A little bit of inflation is normal and even healthy for a growing economy, but if inflation gets out of control, it can erode the value of your savings and your purchasing power. The Fed wants to keep rates low enough to encourage economic growth, but not so low that they unleash runaway inflation. It's a delicate balancing act, and they don't always get it right. Let's zoom in on another crucial player in this whole interest rate saga, the banking sector. Banks make money by charging higher interest rates on loans than they pay out on deposits. It's called the net interest margin, and it's basically the bread and butter of the banking business. But when the Fed cuts interest rates, that net interest margin gets squeezed. Banks have to lower the rates they charge on loans, but they can't always lower deposit rates at the same pace without risking losing customers. So what do banks do when their profits are squeezed? They might try to make up for it by taking on more risk. They might issue more loans to less creditworthy borrowers, or they might invest in riskier assets in search of higher returns. While that might boost their profits in the short term, it can also increase the risk of defaults and losses down the line. Let's talk about something that's near and dear to many Americans, the housing market. Interest rates play a huge role in the affordability and accessibility of housing. When the Fed cuts rates, mortgage rates tend to fall as well, and when mortgage rates are lower, it becomes cheaper to finance a home purchase. That can lead to an increase in demand for housing, which can push prices up. A booming housing market might seem like a good thing, but if home prices rise too quickly, it can create affordability challenges, especially for first-time homebuyers. If the Fed starts raising rates again, it can put downward pressure on the housing market, potentially leading to a correction or even a downturn, while lower interest rates might make home ownership more accessible in the short term. It's important to remember that the housing market is cyclical, and those cycles are heavily influenced by interest rates. We've been focusing mainly on the impact of a Fed rate cut here in the US. But remember, the US economy doesn't exist in a vacuum. It's part of a complex and interconnected global financial system. When the Fed cuts rates, it can create ripple effects that are felt around the world. A weaker US dollar can make US exports more competitive, which can benefit emerging markets that rely heavily on exports to the US. But a Fed rate cut can also lead to capital flight from emerging markets as investors seek higher returns in the US. This can put downward pressure on emerging market currencies and create economic instability. A Fed rate cut is never just a domestic issue. It's a global event with the potential to impact everything from currency exchange rates to international trade flows. We've talked about a lot of the potential benefits of a Fed rate cut stimulating economic growth, boosting the stock market, making borrowing more affordable. But there's a point where too much of a good thing can become a bad thing. When the Fed keeps interest rates too low for too long, it can create an environment of easy money that can lead to excessive risk-taking, asset bubbles, and an unsustainable boom and bust cycle. It's crucial for the Fed to find that sweet spot, keeping rates low enough to support economic growth, but not so low that they create imbalances and distortions in the market. We've covered a lot of ground today, from the immediate impact of a rate cut on the stock market to the long-term implications for the global economy. But here's the thing about monetary policy: it's not an exact science. The Fed has to make decisions based on incomplete information and constantly evolving economic conditions. When the Fed cuts rates too aggressively or keeps them low for too long, it can create a dependence on cheap money. That can limit the Fed's ability to respond effectively to future economic challenges. It's important for the Fed to have a clear exit strategy, a plan to gradually normalize interest rates and wean the economy off of its dependence on cheap money. That was a deep dive into the world of interest rates and the Federal Reserve, but I hope you found it valuable. Understanding these concepts is crucial for navigating the complexities of the market and making smart investment decisions. If you enjoyed this video and want to stay ahead of the curve on all things finance and investing, please like this video and make sure to hit that subscribe button and ring the notification bell so you don't miss out on future uploads. Thanks for watching, and remember, knowledge is power, especially when it comes to your money. See you in the next one.